John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer. I'm a consumer credit expert with almost 30 years of experience in the credit industry. I've spent time at Equifax, which is one of the 3 credit bureaus in the United States, and FICO, which is the company obviously behind the FICO credit scoring system. And so that sound you hear in the background is Tampa Bay. I'm actually in Clearwater Beach, Florida, at a credit event. And an interesting topic came up yesterday during one of the sessions, and I thought I would whip out a quick video for y'all to discuss it. And the topic was specifically one of the Federal Reserve banks recently put out a report. You know, there's a bunch of Federal Reserve banks all over the country. One of them put out a report recently indicating that the effectiveness of credit scoring has deteriorated due to the CARES Act and the CARES Act suppression or prevention of preventing furnishers from reporting late payments to the credit reporting agencies during the pandemic and during what's called the covered period. So let me kind of explain what that means in English and talk about what lenders are likely to do about it. So the CARES Act, which was implemented into law in March of 2020, it's like 800 pages long, and most of it has nothing to do with credit. A very small portion of it does have to do with credit, however, because it amends the Fair Credit Reporting Act. And essentially, the meaningful portion of it, as it pertains to credit reporting, indicates that if your lender gives you some sort of an accommodation because of the pandemic, so either they put your loan in forbearance, or they give you a lower payment, or they do something, waive fees, whatever the accommodation is, and you live up to your end of the accommodation, meaning you still continue to make your payment, whatever that payment may be, if there is even a payment due, and you weren't charged off going into the accommodation, they've got to report you as being current to the credit bureaus. And so obviously current is a euphemism for on time or in good standing. So essentially they have to report you as being in good standing during the covered period as long as you're living up to your end of the accommodation. Well, what that did and what that is currently doing, because we are still in the covered period, is it is essentially preventing lenders from reporting delinquent information or derogatory information to the credit bureaus. And that's obviously good for consumers because they don't want that stuff on their credit reports. It's bad because it disallows lenders and loan servicers from reporting fully accurate information to the credit bureaus, which may actually be real. You may actually be delinquent on your loans, and that information is not making its way into the credit bureaus. And so what that means is the credit scores that are being calculated are not going to be as accurate because they're not considering information, obviously, that's not on a credit report. They can't. So the challenge is, well, does this mean that credit scores are now less effective? And the answer is no, it does not. It does not mean that they're less effective. I'm not sure what in the world the Federal Reserve Bank was thinking. It's like they had a first-year statistician write this report. All lenders have to do is adjust their score cutoffs to the new predictive value of a credit score. And so let's just say hypothetically that a bank is using a credit score and their score cutoff between, a denial and an approval is 620. And they're no longer satisfied with what a 620 means as far as the probability of the consumer going delinquent after they take out a loan with them. Well, all they have to do is adjust that 620 to something other than 620. So normally what happens is that score cut will go up, meaning a 620 might now all of a sudden become a 640. And so what that means is, A, fewer people are going to get approved because fewer people have scores above 640. Number 2 is the quality of the approval is going to go up, meaning that the risk profile of the applicant is going to get better because you're only letting in people who have better credit scores and therefore are lower credit risks. So that's really all that would need to happen for a lender to essentially adjust their underwriting policies to this kind of temporary reality of credit score. So if you have any questions about this, then drop them in the comment section below and I'll do my best to get to them. I think what this underscores is the importance of maintaining really good credit. Because you'll notice that we're talking about scores that are in the low 600s, which is about 100 points below the national average. So these are the consumers, even before the CARES Act, even before the pandemic, who are already marginal borrowers, meaning that they're already kind of close to not getting approved because their scores were not good. You want to put yourself in a position where all that stuff is meaningless and irrelevant to you. And the way that you do that is you earn scores in the 760s and above, because then that really puts you in the sweet zone, and it really, all this other stuff about CARES Act and accommodations and score cutoffs really becomes irrelevant because your scores are so bloody good that lenders are going to be throwing money at you at really low interest rates. So that's my suggestion. Work to get your scores there, and then all this stuff really just becomes entertainment. So thanks a lot for watching, and we'll talk again soon. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.